That's all coming up. But here's where we stand in the markets right now. As mentioned, we're down almost triple digits on the session. The Dow's off 97 points, back to 17,717. The S&P's giving up about 8 or nearly 0.5% there as well. The Nasdaq, interestingly, is managing to stay in the green, but only by about 5 points at the moment.
Let's talk about we got a lot of things to get to in our closing bell exchange for this Friday. Joining us today, Mark Matson, Matson Money founder and CEO. Peter Anderson from Congress Wealth Management back with us. Stephen Parker from J.P. Morgan Private Bank. Michael Jones from Riverfront Investment Group, and our own Rick Santelli joining us as well. Michael Jones, you are long Europe right now. Were you long before the ECB move this week, or in anticipation of it, or why would you like European equities right now?
We've been long Europe for a while, long the exporters and short the currency. And obviously, with the quantitative easing move that the ECB did yesterday, that trade has come right in a really big way. And the great thing about it is when you're long the exporters, you're long the companies that automatically get an earnings boost when the euro goes down. You're also long the best companies in the European markets, because these are the ones that can compete on a global scale, and that means they're very efficiently run and well managed.
Peter Anderson, are you guys buying Europe?
Well, you know, we've always been somewhat exposed to Europe, but right now we're still waiting to see how that plays out, Kelly. You know, there's still a lot of things. I'm kind of disappointed that January started the way it did. I'm still kind of puzzled about the U.S. consumer, too. I was very disappointed in the December sales report. I'm hoping that's going to be revised upward because, you know, Kelly, it just doesn't make sense to me with the low fuel prices and the consumer sentiment. One would have thought that we would start seeing that playing out in the numbers, but let's hope that we'll see it through January and February, too.
Stephen Parker, you like Japan. I mean, that's where you're putting some international money to work right now, right?
Yeah, we actually think, you know, first of all, we saw what Draghi did yesterday. The Bank of Japan's already been on this trade for a while. They continue to be the most aggressive central bank in the world, and that's what everyone's focused on. A couple things that markets aren't as focused on. One, Japan's a huge oil importer. They're going to get a huge boost from this fall in oil prices. Two, the Japanese corporate sector has actually been one of the strongest in the world over the last couple of years. Over the last 2 years, Japanese companies have grown earnings 80%. Multiples have come down over that time period. They're more focused on profitability, they're more focused on shareholder return, and they're actually cheaper than the U.S. and even Europe.
Makes for an interesting discussion about buying the places where all of this quantitative easing has contributed to lower currency prices and whatnot. But I want to go back. You know, Peter Anderson, your point about the U.S. consumer is interesting. We did get that disappointing December retail sales report, but look at Starbucks today. I mean, I can't believe it's up like 6%. And then this after an incredible run, what do you make of it? Are they just taking share from everybody, or is the consumer in better shape than we think?
Well, let me counteract that. I mean, look at UPS and McDonald's. You know, we're getting mixed signals, and I think that's what's so frustrating. By now, I think we would have thought all those names, Kelly, would have been performing well in surprising us on the upside. So
but even
I'm
McDonald's
still there.
I'm surprised on the upside in the U.S.
They did, but I'm still sticking with the fact that all of these companies should be unilaterally moving up. And, you know, JCPenney did okay last December, but as I said, we're not seeing it across the board, and the math seems to work out. You know, it's a stimulus for the low gas prices, right? We know that consumers are not banking that cash, so where are they going? Just to Starbucks? I don't think so.
Yeah. Mark Matson, what do you think of the U.S. market right now? I mean, we're all focusing for obvious reasons on international investing, whether it's Europe or Japan right now, but what about the good old U.S. of A? Are we still in value territory in your view or not?
Well, you have to remember that only 49% of the world's capitalization is in the United States, so there's more opportunities global than here. What a lot of investors are doing is making the mistake of chasing the S&P 500 because it was one of the #1 performing asset categories. We want investors to remember you need to diversify globally. We're in over 46 countries, and that includes not only Europe, but Asia and emerging markets. Everybody's running away from emerging markets right now because they've been down. You have to buy the thing that's down. That's emerging markets, and rebalance your portfolio.
Wow, that's a tough, listen, Mark, you want to get into emerging markets when you have commodities. Look at oil again today. There was no bounce. It was down another 1.5%. When the U.S. dollar's appreciating and that makes everything overseas less valuable, you really want to get in emerging markets now?
Hey, look, what you have to do to be a successful long-term investor is force yourself to do the other things that people aren't willing to do. If you wait for the narrative to go your way, then you're too late. In 2008, 2009, no one was creating a narrative that all this stuff would come back 200 to 300%. rebalance, force yourself to buy the thing that's low. You don't get to know the future and how it's going to come back. Eventually it does.
Rick Santelli, I have to keep recalibrating my feelings about U.S. Treasuries on the long side there. I was trained to get upset when they went below 2.5 on the 30-year or below the October lows of 188 on the 10-year. We're well below those now, and we're all sitting around going, well, let's talk about oil. Let's talk about Europe or Japan. What about these low Treasury yields here?
And they are low, but, you know, just to give you a couple of glimpses as to why maybe it's more prudent not to have a huge bias for lower rates, at least for the next 2 or 3 weeks. First of all, we're virtually unchanged. We're down a couple of basis points on the week for 10s. We're down 9 basis points from 54 to 36, 35 on boons. So we're seeing the difference between the two widen. Lately, when that happens, be a little careful. It means that our treasuries most likely are going to disengage a little bit. Maybe yields float a bit higher. Remember, there's 3 big driving forces. The relative value trade with European low yields. After what Draghi did, this could be under review. The second issue is it's the only hedge against soft equities. And since we have Europe doing QE, there may be less soft equities. Listen to all your guests today. And the third category, of course, is lower economic horsepower. And even though the panel may not agree, I think that's the one turnstile out of the 3 that is still functioning. So you might see rates float up a bit. But remember, we're down 36 basis points on the year. Up till the 23rd of last year, we were off about 28 basis points. It's amazing how similar the first 7 weeks of last year and this year continue to be from the vantage point of interest rates.
That's so true. Michael Jones, just go back to this point as well about will the U.S. consumer ultimately benefit? You like some consumer plays that we're actually going to talk about later on next hour. It has to do with sneakers.
Absolutely. We think Foot Locker is one of the best valued names in the space. We also, I mean, it's easy to get caught up in the government data. It's all backward looking. It gets revised significantly. I think the sentiment data, that's the more real-time measure of what is happening with the consumer. We look at Evercore ISI does some great surveys of retailers, and the week-over-week changes from the couple of weeks before Christmas to the couple of weeks after Christmas, the strongest that they have seen in 20 years.
Really?
That makes more intuitive sense to us, and I think it's better aligned with reality.
With the savings, that's where the gas savings
No question.
Going.
You're not going to be saving it. You're going to be taking it to restaurants, probably higher end than McDonald's, and you're going to be buying that high-end sneaker that you might have thought was out of your price range when you were having to fill your gas at $50.
Very quickly before we let you go, Stephen, you make a good case for Japan because of the lower energy costs right now. Are you ready to buy energy itself at this point?
So for some of our more opportunistic clients, we think that there's a trade short-term in the energy stocks. Sentiment has gotten really, really negative when you look at short interest.
We all expect it to go to $30 now,
exactly.
Right?
It's amazing how quickly that's just become consensus. I mean, that's a big leg down from here. So, you know, I think we have to get ready for longer-term lower energy prices. But when sentiment gets this extreme, you know, if you're willing to take a little bit of risk in portfolios and for the right types of clients, we've been buying some energy stocks.
And if I could add on to that, because there is a baby that's been thrown out with the bathwater in that MLPs have traded down almost as hard as the rest of energy. But if you look at year-over-year earnings gains, the storage and transportation, that's the MLPs, they're still showing double-digit earnings gains, whereas the rest of the energy space has been wiped out. If you want to step in and buy something in energy, the MLPs are a safe place to start scaling in.
We do have a lot of supply, that's for sure. Going to need those things. Gentlemen, thank you all. Appreciate it. Have a good weekend.
Thanks, guys.
TGIF.
50 minutes to go here into the close. The Dow's under pressure today. It's off 90 points. Oil was lower again today, as we were just discussing. NASDAQ is trying to buck the trend. It's now up about 8 points, about 0.2%.
After all is said and done, the S&P and the Dow struggling to stay positive for this new year so far.